Before we delve into the data, let me just say real estate is the best hedge against inflation, in my opinion. I still believe this even in the current market conditions we see ourselves in. So don't get nervous when I go over the data. And at the end of the video, I have a quote from a mentor that should ease your heartburn. So, yes, many people quote Warren Buffett that he hates real estate. If you listen to what he is saying, he doesn't hate it. Investing in real estate is more like, building a business. You have to increase the value of your property. Investing in stocks is mostly just, investing. Other people are doing the work for the business and you're simply supporting them with your money. So, buying a piece of the business, someone else wants to run. So the bottom line, Warren Buffett is a value investor of stocks, not real estate. Someone who does not want to run and manage business or people. He is a buyer of businesses, not real estate investors. But ladies and gentlemen, he's in the game, please. So he plays. So that's one thing to keep in mind. He doesn't hate real estate. So also one thing to keep in mind, this is all done by design. The Federal Reserve has a dual mandate. They have a mandate from Congress to keep both unemployment and inflation low. All of the markets are systemic, dominated by the Federal Reserve, which controls the distribution of speculative cash. The Fed is running the show, folks. Of course, the jobless rate at 3.6%. And the latest CPI reading at 8.3%. It's obviously higher, folks. It's obvious which mandate the Fed has shifted its attention to: inflation. In the Fed's mind, if it can end the housing boom, it can slow down overall price growth. That's why the Fed hit the housing market with an economic shock of higher mortgage rates. So we are in a similar, stagflationary situation similar to the 1970s. I've been saying this for a while. At the end of the decade, only, hard assets, real estate, commodities, gold, produce real gains adjusted for inflation, whereas stock markets stayed flat, adjusted for inflation. Real estate is an excellent hedge against inflation, folks. So the Fed might ease their inflation target to 4% or higher. The government might respond to coming crisis with even more stimulus, which is going to lead to the devaluation of the dollar. And real estate, guess what, is going to go even higher. So the real estate data rolling in for April and May shows that the U.S. housing market is softening. New home sales fell 19% to their lowest since April 2020. Redfin reports roughly 19% of home listings cut their prices over the past month. Inventory is rising fast. Take a look at this chart. Now, what you got to keep in mind, the housing market prices take significant time to change. So the inventory levels might be increasing at a fast pace. But what you have to keep in mind is they're increasing from extremely low levels. So the market is still not back to a balanced market. So, while mortgage applications and existing home sales are also falling, the drop-off isn't a result of seasonality or a soft month or two. Moody Analytics, Mark Zandi, I follow him. He's one economist guy and says it's trajectory flip. Demand is pulling back fast in the fast pace. Bottom line is in the face of mortgages rates that have spiked dramatically. It's pretty honest. So Mark Zandi thinks the housing market has peaked. Everything points to a rolling over of the housing market, he thinks. And in terms of housing sales, they're falling sharply. You have to look at this regionally, folks. Luxury for stuff under $1 million. It's not that simple. So the housing demand is coming down fast. Home price growth will go flat here pretty quickly. We will see home price declines in significant number of markets. Significant number of markets, folks. You have to look at this data regionally. So the U.S. economy has experienced a share of prolonged economic downturns. If you look at history, in fact, many of us might remember the Great Recession, which lasted from 2007 to 2009 roughly. And during that time, unemployment levels soared while the home values roughly bottomed out. And so back then it was a tough time to be a homeowner and real estate investor. But there's always good buys, even in a down market, if you're a real estate investor. So meanwhile, right now, the housing market is sizzling hot still. Home prices are sitting near record highs and buyer demand is soaring. There is still multi-offers on properties, folks. As of late March, home prices were up 15% on an annual basis per the National Association of Realtors. That means there's a lot of room for home prices to come down. Here's the key: without creating a crisis situation that leaves millions of homeowners underwater in their mortgages. I've always said defaults are up across the country. We had these moratoriums. We got to keep an eye on that. More people have equity in their homes right now compared to 2008, which is good as well. So the main reason home prices are so inflated right now is the inventory is low and demand is high. Also, institutional investors like BlackRock are buying homes. If a recession were to hit, it could result in, lessened demand, especially if mortgage rates stay as high as they are right now and keep climbing. And that could in turn bring home prices down to more, moderate levels. So right now, homeowners are sitting on record levels of equity. Not to mention, and this is key too, the 2010 DoddFrank, Wall Street Reform and Consumer Protection Act. So, it had eliminated many of the financial products that underpin the credit-fueled bubble of the 2000s. So overall, homeowners are financially better off than they were, which led up to the 2008 financial crisis this time around. So we also don't have widespread subprime mortgages. Although I did a talk on this, they brought them back and they're allowing that. But it's not widespread from some of the data that I'm seeing. And also, if a nationwide, home prices do begin to plummet, the Fed could always ease up on mortgage rates. They've done that before. But even if a recession hits and home prices drop, they shouldn't fall to such low levels that equity is wiped out. In fact, because the housing market still, solely lacks inventory. So a near-term recession could actually end up minimally impacting home values. That's something current property owners can take some comfort with. And the unemployment rate. Remember the unemployment rate in 2008 bottomed out, and you're going to have people not able to pay their mortgages. So unless the housing inventory really picks up soon, they're unlikely to see a catastrophic drop in home prices because supply is still so incredibly low. As of the end of March, there was only a 2-month supply of available homes on the market, and that's according to the NAR. So that's well below the 4 to 6 month supply that's normally found, in an equalized housing market. So got to keep an eye on the defaults across the country. And we did get help during the pandemic with the moratoriums. Think about if that wasn't allowed with the government help, what would have happened? So because inventory is so low right now, even a notable drop in buyer demand shouldn't result in a housing market crash. If anything, what it might do is open up the housing market, allowing financially secure first-time buyers to financially have a shot at getting into this crazy market and owning a piece of property. As well as lower-end real estate investors to scoop up income property more affordably. I'm looking for that downturn. I'm holding out in certain areas. Absolutely. Don't get greedy and don't get emotional right now. So the inflationary period that took off during the 70s was eventually, put under control by the Federal Reserve, but it wasn't painless. It wasn't painless. Just ask the home buyers in the 1980s. To tackle inflation, the current central bank went through a multi-year phase of jacking up interest rates over 10%, 15%. The Fed, did rein in inflation, but only after high interest rates sent the economy into a recession, and that's twice in the 1980s, and pushed mortgage rates over 18% in 1981. So fast forward to today, when the Federal Reserve is once again pressuring interest rates higher as it works to tackle our ongoing inflation problem. They dropped the ball, calling it transitory for the year. They got political, and they should never do that. They knew there was a problem. So it's hitting home shoppers particularly hard on the lower segment. And over the past 4 months, the average 30-year fixed rate, has shot up from 3.11 in December to 5% as of last week. So if a borrower took out a $400,000 mortgage at 3.11 rate, they would owe roughly $1,710 per month. At a 5% rate, that payment shoots up to $2,147 per month. That's a big difference if someone's watching their money in that segment under, $1 million. So the swift move up in mortgage rates amount to an economic shock hitting the housing market. The question now is, what will it do to the red hot home prices? When mortgage rates are where they are today, homeownership becomes unattainable for certain households. Some people just won't be able to qualify for a home they want to purchase. So everyone's asking, when will the softening come? I think something might come this summer a little bit. You're seeing more days on market in certain segments. Luxury is still red hot. A lot of cash buyers out there. So the housing market chills out a bit as buyers and sellers alike go on summer vacations. That seems to happen if you follow those trend lines. It's too many people chasing too few homes. So maybe we desperately need a breather. So once again, as I said, the theme throughout this video, you have to look at this regionally, okay? Not holistically. Certain markets are going to be affected more than others when a housing market is overvalued. So it means home prices are higher than expected compared to average local incomes. Some regional housing markets have become historically overvalued. If you're an investor, we're focused on stuff 80% outside California. I'm not doing anything in California right now. We haven't for a while. So, and could see home prices decline 5 to 10% over the coming year. If a recession does come, price drops in these markets could, grow to between 10 and 20%. But when you look at how the values went up, not bad, but you don't want to get underwater and you want to make the most ROI as possible. So the most overpriced city in the nation right now, drumroll folks, is Boise, Idaho, which became a magnet for technology workers who wanted to relocate from pricey California cities where the offices shut down due to the pandemic. Boise homes, from the data, are 73% overvalued, making it the most overpriced city in the nation. Take a look at this. Some of the most overpriced cities and regions where home prices could expect to drop by 5 to 10% over the next 12 months include Boise, Idaho, 73%, Sherman, Texas, 60%, Michigan, Muskegon, Michigan, Morristown, Tennessee, 57%, Springs, Florida, Homosassa Springs, Florida, 57%, Lake Havasu City, Arizona, 56%. Okay? Look at it regionally. Here are the cities where the most new homes were built per capita in the first quarter of 2022, and that's between January and March, according to Redfin's analysts and some other websites I looked at of data from the U.S. Census Building Permit Survey. Listed alongside each city is the number of single-family home building permits per 10,000 people it had during this time period. So the data only includes metro areas with more than 1 million residents. So take a look at this. Number one, pretty obvious. If you follow this stuff, Austin, Texas, 31.1, Raleigh, North Carolina, 30.7, Jacksonville, Florida, 29.2, Nashville, Tennessee, 26.6, number 5, Charlotte, North Carolina, 22.9, Phoenix, Arizona, 22.7, number 7, Houston, Texas, 22.4, Orlando, Florida, 23, number 9, Dallas, Texas, 18.5, And number 10, Las Vegas, Nevada, 17.2. So my final thought, what I said in the early beginning, something to keep in mind. Why are people buying houses right now since the housing market is so high? I'm hearing that from clients. Should I wait, Tim? What am I doing? This is crazy, especially for people who are just trying to get in the game. Don't they know that they will never be able to sell it for a profit? No. One of my mentors is 78 years old. He said, Tim, I heard the same statement in the 1970s and then again in the 80s and then in the 90s. And they said it again in the 2000s and then in the 2010s. Here we are in the 2020s and I'm hearing it again. The funny thing is that all of the real estate investors that I know, he said, myself, everyone else he knows are buying, refinancing, and developing real estate projects constantly, no matter what the market conditions are. The reason is because we all know the same thing. Properties will never again be as affordable as they are today. Think about something, that we use daily, like gasoline. In the 1970s, he said he was buying gasoline for, after school lawn mowing business for 17 cents per gallon. Today, a gallon of gasoline costs, $4.85 on average for a car. So if I waited for the prices to come down, I would have never purchased another gallon of gasoline. So many people, hunt. They're hunting for low prices, when they go from a gas station to gas station. But at the end of the day, they almost always purchase gasoline. So when we talk about investors, investors are wise enough to purchase real estate right now using today's lower interest rates. If you look at history, and you do have a lot of cash buyers out there, what are they going to find in the future? They have purchased bargains. So if you think real estate prices are high today, just wait 50 more years and try to buy something then, folks. Alaska was purchased for $7,200,000 and Louisiana was purchased for $15 million. He said, I'm sure that seems like a lot today, but today it looks like it was a bargain. So almost everyone is able to sell their real estate at a profit, because if you keep the property in decent condition, that's key. It will over time appreciate in value. In reality, it's not so much the property values are rapidly increasing, it's the value of the dollar is rapidly being devalued. And it simply takes more dollars to buy something that holds its value today than it ever has in our lifetime. I'm a buy and hold type person. Where's real estate going to be in 50 years in the markets that you're interested in right now? You think it's going to be down? So in some regional housing markets have become historically overvalued, and you could see price declines between 5 and 10% over the coming year. If a recession does come, price drops in these markets could grow between 10 and 20%. But like I've always said, real estate is an excellent hedge against inflation. And you have some publications that I follow both sides of this. Time Magazine said America should end its love affair with single-family homes. Time provided a perspective of affordable housing developers who say people should just get used to living in apartments. You know why they're saying that? Then why is BlackRock coming up and buying thousands of homes across the country? Big institutional investors, because they want to create a nation of renters, and they see the value of hard assets to build a real estate empire and portfolio. So they're buying, and they're not going to stop, but they're telling you, Time Magazine is telling you, just get used to renting. That's a bunch of BS. You look at this data holistically and you break it down. The bottom line is, you're going to try to get in now, or are you going to where do you think it's going to be in 10 years? Where do you think it's going to be in 10 years in these places? You have tremendous amount of cash buyers. You have the institutional investors buying, putting portfolios into real estate because they see the value. It's a long-term play, and it's a great play. So you have to break it down regionally, and there will be some corrections. And we have to keep an eye on the defaults of mortgages across the country, but there's going to be great buys for investors in that segment as well. So just want to share that. Take care. Have a great week. Ciao.